Well, hi everyone, and welcome to the webinar. It's the What Smart Investors Do When Markets Get Noisy. And even just reading the comments, it's just lovely to see some familiar faces, some new names, and also just the fact that, yeah, it definitely is the right time to be talking about the noise and what's happening. I'm sure all of you are hanging on and watching the markets as they come day by day. Maybe that's not a good thing. We'll definitely go through all of that in this webinar. So what I'll do is I normally handle the investor education side of things. My name's Tom Wilson. I've got a background in psychology and markets, worked for brokers. You may have seen me when you have joined up to do the investor bootcamp at InvestSMART. And that's been, I can definitely see some familiar names and faces in here. So definitely, as you know, I'm all about trying to explain things in the easiest possible way. So let's get started. What I'll do is I'll just get my face out of the way and we'll go through. So maybe I'll stick it on the side there. So is this webinar for you? Well, I mean, pretty much everyone I've spoken to in the last few days, if not few weeks, have definitely been wanting a bit more advice or a bit more reassurance about what to do when markets get noisy. So you're more than welcome. Definitely ask questions as we go. I've got a list on the side I can see and I can try and answer them. I'll even put it on the screen. We've also got so many questions that have been submitted before the webinar. Some of them are fantastic and I'll do my very best to get through them all. What I'll try and do though is I won't really give you much tips. Like I can see there's someone there saying, is this the webinar for the hot stock tips? Gee, I mean, normally when we do webinars with the intelligent investor guys, you might have seen some of those. That's a really good spot to ask. That being said, let's get started. So as always, just the general advice warning. So what this all means is that we provide general product advice only, general financial advice. We don't take any of your personal situation into account. If I talk about certain stocks or ETFs, don't think of them as recommendations. They're just being used as examples. That being said, I'll do my very best to try and explain and make everything as relevant as possible. Okay. So let's talk about the elephant in the room. Not naming any names, but a certain person has unleashed a number of different tariffs onto the world economy. There's a lot of conversation about why he's done this, the background, and we'll definitely have different opinions in here. The fact of the matter is that we've seen some significant market drops, haven't we, in the markets? So yesterday we saw even the ASX 200 open and it got as low as, I think, 6% down and then retraced and ended up finishing around about 4%. I was checking the market just before though, and it looks like today is currently actually up 1.5%. And when you look at the reasons for that, a lot of the commentary, a lot of the noise even is saying that the buyers are coming back in. And that's probably quite reasonable. The elephant actually does have a beautiful weave. It's been inspired by a certain person. So obviously all of this chat is causing a lot of volatility. And for those of you that don't really know what volatility means, I guess you could have a look at the chart the last few days. But it's that constant price action. The price is moving up and down in response. Even last night in the US, we saw some of the markets start open and go straight down. And then there was a bit of a rumor floating around that the president was going to put a 90-day pause on the tariffs. And we actually saw the markets shoot straight back up. Great example of volatility. And then they came out and said it was fake news and it went straight back down. So market noise, I think we've really covered that as an example. But the key thing about market noise is this constant barrage of headlines and opinions and, you know, talking heads. And it's really a bit dramatic in terms of it's always crash, boom. I was looking at some of the articles there that you can see on the screen, and there's words like bloodbath get thrown around. That's a favorite when it comes to investment markets. The thing is though, it can push a lot of investors like you, like me, into making emotional decisions, because this is what we see. And it comes to us and we think, oh no, this is the end. For those of you that were invested during COVID, you'll probably sit there and see a lot of similarities. I myself exactly see this happening. I was watching Evan Lucas, who used to work with us very closely at InvestSMART. We did a lot of webinars together during COVID, and watching him on the project last night, he was going through all of the same things that we spoke about, but 5 years ago. So this is a chart here, and I apologize because there's so much information I want to try and get onto the screen, but it's never possible with so much data to go through. This is a chart, and it's taken from Vanguard. Now, Vanguard's got this fantastic tool. It's interactive. They also have it in PDF form, and you can just Google Vanguard index chart interactive. And what it's showing us is I've chosen to show the last 30 years. And if you look at this chart, you can say, okay, the long-term trend is up despite all the headlines, and not even the headlines that we've had just the last couple of days, months. But if you go right back even to COVID in March 2020, you can see that we had a big drop there as well. Now, I remember speaking to a lot of clients during that period and saying essentially the same thing that we cover every time there is some kind of disturbance in the market. A bit Star Wars-esque there, sorry about that. And obviously, if you go back, you can also see other crashes like the GFC, which was obviously a much bigger drop, but then also going back to the dot-com bubble as well. But what I'm trying to show here is that on this Vanguard tool, you can actually track the performance of all the different asset classes over a certain period. I've labeled a couple, and you can see US shares there at the top. It's got some dramatic growth, probably led by a lot of those Magnificent Seven. It's telling us there that over this 30-year period, the annualized return of 11.4% per annum is what it's delivered. You can see Australian shares 9.3% per annum annualized. And cash will stand out there as at the bottom. It's 4.2% annualized per annum, but also it's nice and smooth. And that, I guess, represents the idea that cash isn't that exciting, but it sort of sits in the background and chugs along as well. So those are the different returns for different asset classes. You can see at the bottom, maybe you can't see because it's a bit tiny, but I've also got international shares that are shown there. There's also the Australian property, Australian bonds, international bonds alongside it. So this chart, though, is the exact same chart as before, except that I'm just looking at the last 15 years instead. And the reason why is because I've put on there high growth, and I've also put on there conservative. And the reason I've done that is I'm trying to show where they sit in terms of all these different asset classes. So with the high growth, the conservative, they're generic type, portfolios in this sense. What it's trying to tell us is that because it uses a diversified approach, it's got a bit of all those asset classes inside it. And it means that when one asset class is doing okay, the other one may not do okay, but diversification hopefully allows that it can get through difficult periods, when markets are volatile. And you can see the high growth. So that the upper limit there is 8.9% per annum, which is lower than just buying Aussie shares or just buying US shares. But the whole point is that you're not overexposed just to the actual asset classes itself. Like, you're not just solely concentrated on US shares. And Simon's just asking, is the shares a makeup of the S&P 500? Yeah, the Vanguard website, I believe they use the S&P 500 to depict this, but I'll double check because it could even be the other indices as well. So this is also another feature they've got on their chart there. And what it is it shows us the up days and the down days. Well, technically it's the fall and the recovery. And you can see that the falls are painted in like a light sand color, whereas the recovery is in a blue color. Now, I can only show one asset class at a time, so definitely go back and have a play with this tool. But what it's showing us here is that the market spends more time rising than falling. So this is 5% rises, and you can change that up to, I think, nearly 80% on this actual chart. But it all comes back and shows us the same, that the market actually spends more time rising than falling. And that's the case here with the asset class, which is Australian shares. So 78% of the market's best days happen during downturns. The investors that panic and pull out during the volatile periods, they often miss the market's strongest recovery days. Smart investors stay focused, ignore the noise, and stick to their plan. And that's what we're talking about. We're talking about the smart investors, what they do. Now, we're not just inventing what a smart investor is. We've done some internal research as well, and we've spoken to some of our clients, our investors who invest in our products, particularly looking at during the COVID period and seeing those people that stuck with it and what they actually did during that period. And there's some of you actually in this chat who I recognize as investors, and I've spoken to you before. So, welcome. It's really good that you're coming along and you're watching this. And I would say that everyone in a sense who's actually signed up to things like this, that's a smart investor. So good work already. But the reason why I'm harping on with this idea of staying in the market is you've probably all heard this same old saying of time in the market beats timing the market. Now, investing's full of these kind of sayings, and you've got different acronyms and things like that. But this is quite telling, because even when I looked at this, and I've seen this chart before, it really made me think that a lot of the facts and the data that all of us who work in the industry, we talk about, we put forward, it's quite compelling. So I'll make it bigger again, just so as you can see. Now, what this chart is showing is that if you had $10,000, and it's back in January 2002, if you were to put that $10,000 in the S&P 500 total return index, I should point out that that particular index isn't one that investors can invest in. It's meant to represent unmanaged, capitalized, weighted stocks inside the 500. But it still helps us prove this point. If you were to put that 10 grand in at the start of Jan 2002, on the left there, you can see you would end up at the end with $61,685. And that's an annualized return of 9.52% per annum. That's fully invested. That's a smart investor who said, my time period is this 20 years. I'm not going to take it out because I've noticed that the dot-com bubble has burst, or I'm not going to take it out because of the GFC, all those kind of things. So there's someone who stuck in there from the start to the finish, very disciplined, obviously had a plan, things like that. If you were to be someone who has said, oh, gee, I mean, that dot-com bubble, the GFC, etc., it scared me. I'm going to just sit this one out and see what happens in the next few days, and then I'll go back into it. If you were to miss the 10 best days during this period, just 10, your return would drop down to 28,260, which is about 5.33% per year on an analyzed basis. The more you miss out, so 20 days, you can see it drops to 2.63%. If we get to 40 days missed over a period of 20 years, so 40 of the best days over 20 years, that's a negative return. You actually end up with half of what you started. 60 days, it's actually only 3,698 you got left. So what I'm trying to illustrate here is that if you're trying to be invested, and then at the slightest hint of something happening, you decide to switch your portfolio, or if you decide to liquidate and turn it into cash, put it into the bank, the chance is that you're going to miss those days that are shown here that are actually the reason why we're in this game. It's to take on that risk to try and get that reward. This is the second slide that helps to just explain it a bit better. And it also says why reacting is risky. And these are the 10 best and worst days in the market. And again, we're looking at 2002 to 2022. And this is, again, the same index as before. So if you look at the top, you can see September 29, 2008, obviously around the GFC, it was a negative 8.1%. Then the next October 9th is 7.62. However, on the 13th of October, there was a positive 11% return. And then so forth. So that you can see the 15th, though, it was a negative. But then on the 28th of October and the 13th of November, positive days. So what this chart is actually saying that the big up days often happen during or even after the big down days. So if you're someone that's going to panic or panic sell, you're, based on all the facts, all the data that we've got, you're going to miss the rebound. Peter Lynch, for those of you that know him, well-known fund manager, I think he sums it up quite well. He says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And I definitely think that rings true. Based on my experience, being on this side of the fence, actually talking to a lot of investors, not only in this job, but in previous jobs as well. And the bad thing is that a lot of this, we tend to make these bad decisions, and it's not always our fault. There's a lot of psychological biases that we've got that work against us. And I'll run through them. You're probably familiar with them. At least if you're aware of them, you can start to do something about it and hopefully catch yourself and say, oh, gee, that sounds like loss aversion, or that's recency bias. That's herd behavior. So with loss aversion there, what we've got is, it's a proven fact that we actually hate losing money more than we enjoy gaining it. So we actually feel when we lose $100, the feeling of that is much more severe than the actual pleasure of winning or getting $100. It's crazy, but there's been multiple tests, multiple research and studies throughout history, and that's a fact that we do have that bias. So keep that in mind. It's a really good example of it, that this is why some investors don't get started, or some don't stick with the plan. They fear the fall more than they want the climb. The other thing is the recency bias. Recent losses feel more important than long-term results. So just because the market's had a bad day last week, it doesn't mean that your plan that you've got is broken. A good example of this is the last time my nephew came over. He was a bit misbehaved. So my sister wants to come back next week just for a cup of coffee. But based on his behavior, I don't think I'll ever have him over again. But obviously that's not the case. I realize that his behavior beforehand and likely in the future, fingers crossed, is going to be fine. The last part there is the herd behavior. This one's fairly straightforward. The thing is, though, we do find ourselves getting caught up in this without fully realizing it. And there's heaps of good examples, but we're basically following the crowd. We're buying high and then selling at low prices. We assume that the crowd itself knows what it's doing, or maybe we even let it make the decisions for us. And the good example is, again, the dot-com boom and subsequent bust. A lot of people didn't actually understand what certain companies that were being listed in this boom, such as like pets.com. There obviously were some really good companies that came out of it, Amazon, for example. But a lot of us just blindly went through it. You might even think of some cryptocurrencies coming to mind, where, again, it can be proving this herd behavior. So what does the smart investor do? Okay, so we'll go through the 5 steps. It sounds a little bit like Alcoholics Anonymous, the 5-step program, but this will be a bit more fun, I promise you. So I was talking before about, we've spoken to a lot of people who have actually shown us that they're able to get through periods like this, and at the end of a certain period time frame, they can say, I've met my goal. I'm going to take my money out and use it for whatever the reason I had. We've spoken to those people in person through all of our customers and investors that we've got, the ones that have followed this and have done well. And again, it just seems to also prove this kind of planning and also some of the actions that they've done. So when we've spoken to them, they've all got that plan. And the reason why they've got the plan is that they want to remove any kind of emotional parts that are going to act as resistance during their investing. Now, if you haven't got a plan, that's okay. It's probably a good time to put something together, particularly now that we've got so much volatility. It gives you a chance to sit there and put down on paper what you want to try and do. Now, setting a goal, fairly obvious, you would think, but there's a lot of people that don't really have a reason for investing. Myself, I like to invest just to create some wealth, holding some investments that are outside of superannuation so that in the future, I'll be able to rely upon it if I decide to retire early. But I mean, who knows? The other thing is the know your time frame. And this is probably one of the most important parts because it can really dictate what type of investment you're going to get into. Now, as an example, when I speak to some of my friends who come into money, they might get a lump sum of something or a bonus. They'll usually say, Tom, you're in investing. You work at that company that talks about investing products and markets and etc. I've got 20 grand. What should I put it into? And the first thing I'll always say is, well, how long do you want to be invested for? And like, what's your reason? And they'll say 1 year. And straight away, that will ring alarm bells for me because it means that 1 year is such a short time when it comes to investing. Investing is a long-term game. So I'll naturally say, look, you're probably better off putting in something that's liquid, that's easy to get to, and it's probably not going to move up and down, but also is capital preserved. So you're not going to lose your actual starting amount. And that's when I'll usually say cash or cash type products. Obviously, there's exceptions to that rule. It depends on how much you've got invested with certain banks. The government's got a certain program that covers one banking license when you've got 250 grand deposited with it. So it picks up the slack if something goes wrong. So with short term, we need more stable assets that are not really going to change in price day to day, because if you were like my friend to put the $20,000 into a high growth portfolio, that's about 80% growth stocks or equities and 20% defensive. In a year's time, he could be literally on the other side of another set of tariffs that Donald Trump has put forward, and he could actually be going backwards because he needs that longer time period to wear out the ups and downs, just like that chart we showed at the start. Long-term, room for more growth assets. Matching your risk, and this is so important too, because a lot of people tend to forget how you feel or how you factor into this decision-making process. If you go and see a financial advisor and you sit down with them, they'll ask you questions like, how do you feel about risk? What would you do if the market dropped 10%? What would you do if the market dropped 20%? And the way in which you respond to those, they'll then go ahead and recommend different products for you. So what we tend to say is, how do you feel about risk? If you're someone who, even when you see a 10% drop, no one likes to see it, but if you get that caught up in that and you don't realize that's part of investing, unfortunately, you might be best just to dial down your risk profile. So what I mean by that is, let's just say that if you said my time frame is 30 years, nice and long, but every time I see a bit of red on the stock market, whenever I see that there's 10% drop over a period of a few days, I get a bit of a heart attack, or I get like, well, heart attack's probably a bit extreme, but a panic attack, I should say, or maybe I don't sleep because of that. That's when you would definitely want to be dropping it down. Peter's saying that for 12 months, I would choose a term deposit guaranteed return. I mean, that seems to make sense, doesn't it? You obviously are going to get a lesser return than being in something like a diversified portfolio, even a conservative, where you've got elements or exposure to equities. But that's just so important in terms of the conservative portfolios tend to have a suggested minimum time frame of 2 years. So it means that even something like that, may not be suited for someone who's got less than that 2-year period. So that's a very good point there as well. So the other part is the stick with the plan. Now, this is going to be relevant for maybe a lot of you that are already invested. And there were a lot of questions as well that we've got in terms of what do I do? Do I sell now? There's been a drop in the market. I try and put it just as simple as possible. And this is a real scenario that myself, Evan Lucas, all the other people at InvestSMART, and probably in the industry, we dealt with on a daily basis when speaking to people. So I've got Jane. Jane's not a real person, as you can tell, but what she did was she invested just before the COVID pandemic, before the crash, and she saw the value of her investment go down, which obviously a lot of people did. When she spoke to one of us and said, "Oh, I'm that worried. I'm just noticing a lot of red in my account. It's gone backwards. What should I do? I'm thinking of just selling out and just taking the money, and I'll wait until COVID goes away or the markets go back to normal." And often we would say, well, so what's your plan? Like, you want to be invested, but you want to wait for the market to go back to normal? And Jane would say, yes, that's what I'm hoping for. Maybe before it drops, when the market goes back to there, that's when I'll get back in. So obviously we try and say, well, going back to all that data and the facts that we had before, that you might miss the up days and things like that. Obviously, if it's something that you want to do in the end, no one's going to stop you and say you can't do it. But all the data, all the information is strongly saying, definitely have double thinks or multiple thinks about it. Because in this instance, what happens is that loss that you're seeing on your screen, you have to think of it as a temporary pricing of what you're holding. It's basically saying that if you were to sell now, the market is offering you this and you're accepting that. So until you do that, it's purely like a paper trading loss. And until you actually crystallize it, you don't have to actually wear it. So what we saw was the people that did take this path, they would lock in the loss. And unfortunately, it was usually at the bottom of the market. No one can pick the tops and bottoms. I can't. Other people who I talked to, I had dinner with Alan Kohler on Wednesday night. He was talking about this, in quite detail. And no one knows. We can try and give our best estimates, but the thing is that no one knows. And anyone who says that they do, just be very wary of those people. So in this instance, locks in the loss at the bottom of the market. All the dividends, all the income distributions, and even interest payments that you might have been eligible for, you're basically missing out on those as well. So you're sitting on your hands, you've taken the loss. When it comes to diving back in though, you see the market go back up to where it was, which happened, and then you'd hesitate and say, oh gee, do I get in now? It might drop again. What if I just let it go a little bit further to confirm that I'm right? I need more information. And what tends to happen is that the investors that follow this, they get back in and they've missed that rebound. They've got in at a higher price, and now they've got to try and make up for all that loss that they experienced. Alternatively, the majority of the people that we spoke to and invest with us, they stayed invested, they followed their plan, and it meant that they didn't have to have any sales costs, like in terms of paying brokerage when they sell. They didn't miss out on any kind of income, and they were able to be positioned ready to experience that rebound that ultimately came, which I guess is exactly what I was trying to say before at the very start of the webinar, showing you with the real data. I mean, this is anecdotal in terms of this exact example, but it's something that I've experienced and spoken to a lot of people about. So the step 3 for the smarter investor is they invest regularly, not emotionally. I mean, this is fairly self-explanatory, this chart. You can see the up and down type of the market. They're investing the $500 each month, usually on a set date. So maybe the 15th of each month. There was a good question actually before talking about, is there a good time to buy ETFs? My experience, having even worked at a broker, it tends to at least be an hour after market open and an hour before. And that often goes the same with different shares as well. You'll find that's the tightest spreads, particularly with the market makers. I'll try and go through and add some different things as I go, but you can see here that this particular investor, they're committed to making a regular contribution of $500 per month. They, in Jan, strike it lucky, bottom of the market, and they might buy some units there, or they will buy. Then Feb, the market's rising, doesn't matter, they still invest. They get less units because the price is slightly higher, but their $500 is still put in the market. March, top of the market, and they obviously get less units at that higher price, but then it drops and then it goes back up. And what you tend to find is that at the end of this period, they'll have an averaged out price. So that's dollar cost averaging. It helps to smooth your entry into the market. But the biggest thing is that if you can automate this, it removes that emotional part. And the example I have here showing the emotional part, again, is a real example. I've spoken to real people that have gone through this. You've got your investor in the blue who we've already seen. He's, set up an automated regular contribution. The second one, the one that's in green, hasn't done that. So for them, they've done the $500 in Jan. Then they see the market rise, go up in Feb. So they're like, oh, gee, that's not good. I got it back into Jan much cheaper, the recency bias. When it comes to March, top of the market, they're like, oh, definitely not doing it now. Like, why would I do that? I got it so much cheaper back in Jan. I'd be a fool if I did this. They wait until April, market's going down. They think, oh, it'll probably fall even further back to Jan's lows. And then in May, they realize, okay, so it seems to be at the same amount as it was in April. I'll buy something here. So they put the $2,000 in that they've accumulated from the months that they haven't invested, and they buy all those units at that higher price. Same with June, they put the 500, and then with July, they put some at the end. But basically what's happening there is that because they've added that element of that decision-making and the emotion, that's influenced their decision, and ultimately it's ended up not working in their favor. So the other thing here is the step 4, avoid the common investing traps, the chasing winners. Obviously jumping into something when it's already taking off. Then there's the switching strategies. This is a really big one because we speak to a lot of people about this all the time. And some people have asked, talking about, with the markets that are dropping, with the tariffs that are coming in, should I just change to cash? You have to ask yourself the question, are you doing that because you're panicking and you feel like everything's out of your control? You don't feel like you can follow the plan anymore? If so, that's a decision that's up to you. But also, if you're wanting to stick with something that's following your plan, that's going to be the better way to do it. Because when you're changing, chopping and changing, we go back to that very start, you're going to miss those best days in the market, and you're also going to add more expenses when it comes to your trading. The last thing there is ignoring rebalancing. Now, rebalancing is a very good example. It's a question saying, is there any proof about rebalancing? Like, does it actually work? And yeah, there is proof. What you tend to find is that, say, for example, with the InvestSMART portfolios, they've all got different allocations to different asset classes. Let's pretend that for the international shares, that they have a huge run up. So normally we might allocate 20%, and then all of a sudden it goes up to 25%. Now that's great. It's going up in value. That's what you want. But if you were to let that run, what would tend to happen is that it wouldn't be a high growth portfolio anymore. Basically, when you invest with us, you're saying, I want a high growth risk profile. And our job as the manager, which is why you pay management fees, is to keep it in that risk profile. So we keep it in high growth. But what we tend to find with rebalancing is that it doesn't always, but it can help to predict different ups and downs in the market. So what I mean by that is if there's a big run and we find that the international shares go up to 25%, we'll trim it back and bring it back down to say 20%. And then we reallocate that money to the other asset classes that maybe they've dropped so we can buy a little bit lower. But what it's doing is it's making sure that you're taking those profits, you're banking them, and you're putting them back into the portfolio at the same time being in line with your risk profile. What I'll do is I'll get to the step 5 because we're nearly finished at least with these steps. Step 5 is use the right tools. Now, hopefully a lot of you have gone through the it's coming back to me, the InvestSMART website. There's so many different tools on there, like the filter and compare ETF tool. This is something that we ran a bit of a campaign on a little while ago with Effie Zahos. She and the rest of us did a lot of videos about it on how to use it. But essentially what it does is it allows you to research ETFs and use the InvestSMART star rating. Now, the InvestSMART star rating goes through and ranks each one based on different criteria, such as like how liquid they are, how expensive they are to own, how they actually follow the index they're meant to try and replicate. Definitely take a look at that. I'll make these slides and the video will be available after the webinar. So definitely go to the website and check that out. The other thing too is that you've got the statement of advice tool. So if you're someone that hasn't invested yet, or if you're thinking about opening up a different investment, this statement of advice tool, it's a limited statement of advice. And limited just means that it's going to talk about our products, not everything else that's in the market. But you can go through there, type in your goal, your time frame, the risk profile, and it will suggest something that might be suitable at the end of that quiz. Speaking about the different portfolios, so our portfolios are designed to be automated, to let you add to them, not have to worry about the strategy. You can set up the automation in terms of the regular contributions, that dollar cost averaging example. You can also have automatic rebalancing, which is standard default set for each of it. The other thing too is you might have just noticed that we've introduced zero buy-side brokerage, which means that if you add to your account, you get rewarded. You don't pay brokerage anymore when we buy ETFs for you that go inside that. Obviously, when you're selling, the brokerage is charged, but the brokerage is very low. What I was going to do, because we have a lot of questions about changing to cash or changing different allocations, I was going to run through the investment portfolios that we've got. The other thing too is that this month, if you open a new InvestSMART professionally managed account and get it funded before the 30th of April, 2025, you actually get a bonus $100 top up. So what I'll quickly do is I'm just going to show you the portfolio so that you can have a look at them and just understand. This is that filter tool that I was talking about. It allows you to do something like, there was a question about VGS that we received, just saying that should they look at getting rid of it because, companies like Nike and other companies, US companies, and it might get boycotted. I don't know your situation, but the reality is that it probably won't have too much effect on it. This particular one, because this VGS, which is run by Vanguard, is an international shares ETF. And you can see here, we typed in that code deliberately, but it's got the star rating here on the right, and you can actually click or hover over it, and it will tell us how it does calculate that. But if I was to type in Australia, 10% tariffs for us, it would give me all the different ETFs that have the word Australia in there. So you can see the beta shares, Australia 200, but you'd also find as we go, well, I probably made it too long, but there's also going to be the IOZ, which is what we use inside our investments. So you're probably familiar with some of the portfolios. You've got the diversified on the left-hand side from conservative to high growth. I'm just going to click on high growth just to quickly show you how it works for us. And one of the key things is these are diversified. So they're across all these different asset classes. And if I go into asset allocation and holdings, you can see here, this is what a high growth risk profile looks like. So 49% in international equities, 36% in Australian equities, and then property infrastructure, fixed interest, and then cash. Now, we also show you what we literally purchase on your behalf. So you can see here on the right-hand side, there's the Beta Shares Australian High Interest Cash ETF, and you can Google these and actually see much more information about what's inside. But with that particular one, it has the ticker code of AAA, and inside it, it's got a lot of different term deposits or high interest cashes, and then it's wrapped up inside an ETF. Like I said, we use the IOZ, the BlackRock iShares. We use that to get our Australian equities exposure. So I'll just go back up. Because we have capped fees, they've recently changed as well. We tend to find that this gap between us and our peers is getting wider and is getting wider. There was a couple of questions just asking about what's the cash like inside our portfolios. Well, you can see here for the high growth, it's 4%. And then there's 5% that's to fixed interest, which is bonds. If you were to go to, say, the conservative, now conservative drops down to the 2-year suggested time frame, and you're not locked in with any of the InvestSMART portfolios, but obviously we're saying that to realize the full benefits, 2 years minimum is suggested. I'll go to asset allocation again. So as you'd expect, because it's conservative, it's flipped that 80-20 to a 20-80 type ratio, and cash is now 17% of this particular holding. Whereas fixed interest is the bonds that I was talking about, both domestic bonds here in Australia and overseas. It's 53%. So obviously we would counsel against, based on everything that we've been through in this webinar at the start, talking about missing the good days, reacting and recency bias and panicking. But the thing is that if it's something that is affecting you a lot, you still do have the option to change portfolios. And there are single asset class portfolios here. And this is the cash securities portfolio. And we call them single asset class because it's just the one asset class, cash. And inside it, it's 100% to cash. And I believe it's the AAA ETF that's inside it. There are also other ones here too, such as the property infrastructure, international equities. But the thing is that if you do need to change, if you're already invested, you can actually change from one to the other, or you can add new portfolios alongside, or actually not alongside, but you can add new single asset class portfolios alongside existing. And with diversified portfolios, let's say, because a lot of questions we're getting as well about retirement, about what happens, particularly with moments like this now. You've got your plan going to retire. What should you do? Should you be changing it all to cash? The thing is, try and think of it as a plane landing. You want to have a really smooth glide into it. So in your plan that you've done, if you have 7 years to retirement, you might find that something matches that in terms of the suggested time frame. The idea is that maybe every year or two, when you think is suitable, you could look at changing it and maybe reducing that risk profile, because eventually you'll end up in something like a conservative that might hold much more capital stable investments and produce the income, which is what people who are in retirement want. Unfortunately, even Evan Lucas was talking last night, and he was saying that even with retirees nowadays, they still need an element of the equities, the growth part. Sort of gone are the days where you can just be completely, depending on what your balance is, just being focused in income producing assets or interest bearing. There's some really good questions here as well. And Rob even is pointing out that unless you're invested through an SMSF in retirement phase, rebalancing has tax implications. And yeah, you're exactly right. Rebalancing, the nature of when we do sell something to redistribute it into the other asset classes, it can trigger a capital gain or a capital tax event. That being said, we would still say that the rebalancing still has so many more benefits, particularly if you are in the retirement phase and if you're in some portfolio where it's good that the certain market is taking off, but you don't want to expose the risk to one asset class to the point where it becomes the international equities portfolio with a dabbling of other asset classes. But again, it's not straightforward, is it? What I'll do is I'll just jump back to the slides here because we're very close. Well, actually, we've reached the question and answer. I'm happy to go through anything in more detail. If you've got questions as well, definitely pop them in. I'll do my best. Otherwise, what I'll do is I'll quickly just run through a couple here. Ryan was asking, is there any ideas to better focus your financial news diet? So that's a really good way to cut down on the noise. Personally, myself, I exposed to a lot of this day in, day out. I try not to watch too much of the actual news on TV, but it can be quite difficult. There's so many good tools these days as well. For those of you that even have ventured into AI, there's a lot of tools that even with ChatGPT, you can set up a task type system and it can notify you on a daily basis of any topics that you might think are newsworthy. You can also tell it to not give you very extreme type versions of the news. Albie was asking about IIGF. That's the Intelligent Investor Growth Fund. Apparently, I think Nathan Bell, who's the portfolio manager, is going to touch on that. So I probably won't touch on that myself here. And Peter's saying there as well that you can also rebalance through a retail or industry fund tax-free in retirement phase. It's been a long time since I did my accounting degree and my tax law is a little bit rusty. So I definitely need to brush up on that. That being said, I'll keep it for a night when I have a bit of a sleep because I'm sure it probably hasn't improved since I last studied it. I'll come through a couple of other questions that have been, and this is a great one here, Diane. Diane submitted this. It's great to see you again, Diane. Thanks for asking this question. Asking about historically, have dividends and distributions been affected much during market downturns? When we looked in the COVID period, we did see a few Australian companies reduce or even scrap their dividend. Some of the stats that I've got here, and I'm just looking at a different screen because I've got it all recorded. In the GFC, that was 2008, 2009, the S&P 500 companies, their dividends were cut by around about 23%. So about 1 in 3 reduced their payouts. That's a particularly specific example because a lot of the banks were hit in the GFC that were paying those dividends. And you tend to see during moderate downturns that you get, stagnation when it comes to the cuts, or even small cuts as opposed to big drops. A lot of the companies, they don't really want to, limit their dividend because they want to at least have that because it's very closely tied to their share price. Clive, great to have you here, Clive, as well. Does InvestSMART calculate our capital gains tax? Yeah, they do. At the end of the financial year, a little bit of a delay, while all the ETFs that we hold for you report, we actually send out a tax statement or a tax document for you, and it lists everything in the one document, which you can then give to the accountant, or if you're lucky enough to do it yourself, you can then go through and enter it into the ATO tax return software. So yeah, it does calculate the capital gains for you that you then enter in, and then they tell you what the actual tax is on that. There's some more questions here. I'll just knock off at the same time. Yeah, so did smart investors do the same thing prior to the second leg of the global financial crisis? Yes, they did. It's pretty much the exact same information that I've gone through, but one of the key things was that staying diversified and staying to your long-term plan. If you actually stuck through it, that chart that I had at the very start, it does show that eventually it would get you back. There was a question, or actually even a statement just a little bit back at the start. I'll just find it, because it was talking about the GFC. And it was Patrick just saying GFC took 11 years to recover. Great if you're younger than me. Good point. And the thing is that when you actually go back to the GFC, and if you were someone though who, say you did experience the downturn, which I believe even for the US markets was around about 44%, which is a big drop. But obviously, we saw that chart at the very start. The thing is, though, if you were someone who through that period was making regular contributions back into that same account, if you stuck by that discipline, you'd actually find that you would have gotten out of that much earlier. And I believe that it's estimated to have been around about 2013 as opposed to much, much longer. So the catch there, though, is that, if you're someone that is in the retirement phase and doesn't have that time frame, you may not be able to make those contributions, which is why understanding your time frame and that investment plan is so crucial. If you can do that and sit down and do a plan where you know that in the future you might be retiring at a certain age, that's fantastic. Sometimes you might retire a bit earlier, other times you may not. The CGT, in terms of first in, first out, I believe that it is first in, first out, but I have to double check just to make sure there for you, Peter. I believe it is. I'll just have a look at some other questions, but we're getting very close to ending. There's the questions about the cash holding levels in the InvestSMART diversified portfolios. This is a very, very good question too, because the thing is that a lot of people presume that the InvestSMART diversified portfolios, that there's a team of people behind the scenes who are monitoring every single movement in the market. And when we see drops like we did yesterday, or if we see, President Trump on the news talking about this and that, some people think that what we do is then we try to anticipate that and we might boost the cash allocation. So even in the growth portfolio or high growth, we might change that cash allocation from 4%. And we might try and anticipate and put it up to like 10%. We don't do that. It's not something that we do. What we actually do is there's the Morningstar diversified portfolios, and they act as the instructions, as the blueprint for your standard. It's the benchmark for your standard different portfolios. And our job is to try and get as close to that benchmark as we can. Now, we can't get exactly the same return or even higher, but we can get close to it, which is what you would expect for a passively managed investment. That being said, the investment committee, they meet every quarter, and on that committee is Paul Clitheroe, our CEO, Ron Hodge. We've got Effie Zahos is there too, Alan Cole is part of it. And what they do is they make a decision. If they look at the underlying benchmark portfolio and they'll say, yes, we need to adjust so we can match that, then they'll go ahead and do it. So in your account, you tend to only have those rebalancing events when the investment committee decides to do it. If you're adding more funds, and obviously we need to buy more and rebalance and spread it across all of your asset classes, or if there's been some kind of change itself that needs to be flown through. Let's have a look at some questions. Phillips is saying, I asked Alan on his podcast last week, based on something he said in 2017, where can we go to find a fund returning 15% per annum? Very good question. I hope he answered it for you, but if he did miss it, if you have a look at, I can show you just back on our website. We've got the ETF tool that I was showing, but if you go up to compare your fund, you can search for different funds inside here. But even if you go back up to insights, top performing ETFs, it'll give us a different system here where we can actually search different funds. These are all the ETFs, but we can click on compare ETFs and we can even choose different asset classes or even managed. But that's a good question. I hope that he did answer it for you, but if he didn't, definitely using those tools might be able to help. So we've reached pretty much the end of the webinar, which is a shame, because it's been such a good trip down what happened back in COVID, and obviously they're not the best feelings, but hopefully we can take what we went through during that period and apply it today, because there is a lot of concern about there in the market. No one likes to have a losing portfolio, but the thing is that if we can try and take into account what tends to happen if we aren't calm, cool, and collected, and if we do panic, we will tend to miss those days. But that being said, if you do have any kind of concerns, if you do have any kind of questions that you need answered, you can always contact InvestSMART. And we've got the chat that's on the website that a lot of you have used before. We've also got the phone, the email. You can also reach out and even schedule a phone call to speak to one of us as well. And you can follow us on social media. In fact, I'll be putting up a version of this webinar on YouTube, so definitely check that out. And Helen has said, thank you, Tom, I won't panic. That's good, Helen. Good work. That's what we're here for. And Lincoln's saying that the recording will be up there as well, but we'll send out the recording also to you along with some highlights of this webinar. So I'll just put up our details here again if you want to go to the website, get more information. But the other thing too is if you send emails suggesting, oh, I'd really like to learn more about this and that, this topic, I'm more than happy to do webinars and talk about these things. I can also invite different people, across our company, across our brand. We'll do more with Intelligent Investor. We do at least one with them every 3 months. So look out for that as well. But thank you so much for attending. It's a real joy, and it's a privilege to have a lot of people like yourselves who often, that you're part of our community and you're very supportive, and you ask a lot of fantastic questions, and we're more than happy to answer it. We're an Australian-run company for Australians and some people overseas as well. But we try and do the best by everyone. So thank you, and we'll get this out there and stay calm.